2 p.m. Eastern Time. We're coming to you live from the floor of the New York Stock Exchange on the corner of Wall and Broad, and this is a special Fed Day decision announcement. We will get the announcement from the Federal Open Market Committee. Fed Chair Jerome Powell will speak live at 2:30 p.m. Eastern Time. We will have that for you and carry that live as soon as he hits that podium. We'll have that for you. In the meantime, most folks are not expecting a rate cut right now after 3 rate cuts last year. The decision is imminent. It should be coming in just a moment. Right now, we have seen stocks taking a leg down prior. For example, the Dow about 10-15 minutes ago was up. Right now, I'm hearing on the floor that it's unchanged, waiting for confirmation. The Dow was up about 7 points about a half ago, and that is confirmed now, unchanged. And we're seeing the Dow down about 30 right now. And so we had a 10-2 vote. You had 2 dissenters. Obviously, you're going to know that Stephen Myron's going to be one. And his time is about up. And so we'll figure out who the other one is in the meantime. But that's what you heard. Right now, you see that the Dow is down about 25 points. Whoa. And I'm looking to see if there's any big change in 10-year bond yield, still at 426. That has not moved. Gold has ticked a little bit higher, had been up about 195 points. It went up about $10. Now it's up $205. We're also seeing oil at 63 and change. That pretty much has stayed steady. The VIX has stayed steady at 1670. It's at 1655 right now. The dollar, which has shown weakness, is at 4-year lows, is at 96.38. The president not particularly concerned about a falling U.S. dollar at this time. You do see also Bitcoin at 89,625. It is up 235. That is up 0.25% to sit at those levels. So in the meantime, the Fed leaves rates unchanged as anticipated. And really the bets for rate cuts are for June and December at this point. So folks are expecting 2 cuts this year. We'll see if that changes for June and December. Kevin Hanks is joining me live from the CBOE. Let's get some reaction here. We just heard from the Federal Open Market Committee, unchanged, and the vote was 10-2. Your thoughts?
Hello, Nicole. Yeah, 2 hours left in the trading day. We get our decision that we pretty much expected on 2 dissenters, Stephen Myron and Christopher Waller, who preferred to lower the target range for the Fed funds rate by 0.25%. So those were the 2 that dissented. It was Jerome Powell, John Williams, Michael Barr, Michelle Bowman, Lisa Cook, Beth Hammack, Philip Jefferson, Neil Kashkari, Lori Logan, and Anna Paulson all voting to hold. So now it comes to the all-important press conference. And Jerome Powell is going to get asked a lot of questions that he may dodge, but he's going to have to give a look at what he thinks about the economy. Is it going to be 2 rates? Is he going to lean a bit dovish, lean for 2 rates or possibly more? Is he going to talk about the relationship between unemployment and inflation? Is he going to mention tariffs? All these things are going to be topics. The Q&A should be wide-ranging. It could talk about his career. It could talk about Lisa Cook. There's a lot of things that can be mentioned here in this press conference. I think it's going to be one you want to watch, Nicole.
I mean, when you talk about what's the Fed's mandate, right? As you said, it's full employment and price stability. When it comes to unemployment or full employment, he said that unemployment rate has shown some signs of stabilization, right? So that is meaning that we're not suffering in the labor market. We don't need a cut right now. And then the other thing that he noted was that inflation remains somewhat elevated, and that's always a concern. Is there inflation? And if they think there's going to be inflation, they're not going to cut. So at this point here, not surprised to know that it was Waller and Myron. Myron could have gone for 50. I mean, he sort of went to 25. He was a 50 guy recently, most recently, right? Now he went to 25. Waller is the name that has already been confirmed by the Senate. If they choose him, if President Trump chooses him to lead the Fed, it'll be very interesting because then the Senate cannot reject him so easily. Right, they may reject somebody else like Stephen Myron, but they wouldn't. Which he's not even on the, in the ballot, like Rick Reeder. Okay, but Waller, they've already confirmed him. So it'd be a little strange if they rejected him afterwards. You know what I mean?
Well, listen, I think any Fed choice by President Trump is going to be fought by the Democrats. They oppose everything no matter what it is. So that there's going to be resistance there no matter what it is. And so, you know, a lot of the names coming up, the two Kevins, Christopher Waller, and then Rick Reeder, who, you know, there's been a lot of speculation on some of the campaign contributions that he's made in the past. So we'll see, but he is well respected in this industry, as are all the candidates down to the final four. So yeah, I think, but we're waiting for President Trump. Does he wait till after this meeting to make the announcement? Maybe that's what we're waiting for here. But I think Jerome Powell is going to talk about some of the topics. I think he'll dodge or not answer a lot of the topics about his future and all the lawsuits and things like that in the Department of Justice, Lisa Cook. There's going to be a lot of questions that don't have anything to do with the U.S. economy and lowering interest rates. So that could really distract this market, or the overall market, from what we're about to hear in the press conference. I think it's going to be one that it'll be difficult for Jerome Powell to stay on topic today, because the questions are going to be all over the board, Nicole.
I think he's going to speak very slowly in Fed speak. I mean, as he knows so well how to do. The Fed cut rates 3 times last year, and now the likelihood of cuts this year, and it was my last check that they said people were thinking June and December, especially once you have the new Fed chair in place, you're likely to get a cut. You know, right? Don't you think that seems to be the talk on Wall Street?
15 minute, man.
I would agree with that. I think Jerome Powell has lowered rates for the final time as he is chairman of the Fed. I think the next cut will probably be the next Fed chair. I think that's accurate. And the probabilities show that, right? Now, that could change, as you know. Also, he could talk, here's another topic he could talk about, the balance sheet. And are they buying securities, and how much are they buying, and what are they doing with those? So, listen, I think there's so many topics. The market pretty much unchanged from where it was. I had the S&P down 0.09. That's what it just ticked to right now as I'm speaking. So the markets really haven't moved. I think once we get past this, the real attention of the markets will turn to earnings after the bell, and Meta, Microsoft, and Tesla will have earnings after the bell. Those will be big news. That'll really drive the market, you know, overnight and tomorrow.
And Apple on Thursday. You're absolutely right. It was interesting. I spoke to Jay Woods earlier, and I was asking about 7,000, how exciting it was. We hit a record today, and he said, look, I feel like the market is really having a top formation here, and I really need to see more from these earnings to make me feel that confident that we break through and out. So he's on more of this wait and see type of mode. We do see that the Fed kept their rates unchanged. Let's see, reaffirms the statement on the long run, monetary policy strategy, 10 to 2. We got that. All right, look, we got everything that seems that has come out thus far. Great job, Kevin Hanks. Thank you. We bring in John Lonsky, President Lonsky Group. It's great to see you, former chief economist at Moody's Investors Service. It's wonderful to see you, John Lonsky, because people are wondering, you know, look, we had so many pauses in between. Let me see. We had a 50 cut in September of 24, then 25, right? November, December. And then we had 1, 2, 3, 4, 5 pauses, and then 3 cuts last year. You know, are we in pause mode and then more cuts to come?
Definitely in pause mood right now. And I couldn't help but notice that opening sentence of the policy statement mentioned that the U.S. economy is now experiencing solid growth. And that tells me that the Federal Reserve is in no rush to go ahead and cut interest rates. I mean, after all, we are going to be receiving a record amount of tax refunds fairly soon. And moreover, we're also going to have an increase in after-tax income. because of tax cuts that were part of the big, beautiful bill. It's this type of fiscal stimulus that I believe Fed policymakers want to take a close look at and see whether or not this huge amount of fiscal stimulus goes ahead and provides a lift to consumer spending, such a big lift to consumer spending that the pricing power of businesses becomes enhanced.
We've seen improvement. You're right. In GDP, that's been going up. Inflation's been coming down. So things have been going in the right direction, maybe slower growth for jobs and things like that. But you have some wild cards that could affect the market. And maybe the Fed deep down is also saying, look, I don't know what happens with the Supreme Court SCOTUS when it comes to tariffs. And they've adjourned now, so you won't hear anything before February 20th. But they must be thinking in the back of their minds, what if the Supreme Court votes against it and what happens? Do we have chaos of some sort? The government shutdown is looming again, another government shutdown. That's a wild card. And the third wild card would be who will be the chair of the Federal
You think
Reserve.
it's going to come up with a retest in 95?
I know the Fed has a serious mandate, those two things that we discussed. They must be thinking about some of those wild cards.
Yeah, those wild cards. Yeah, you're talking about the Supreme Court decision on tariffs. I guess the feeling in the market is that the Supreme Court is going to reject reciprocal tariffs in their current format, but the Supreme Court wants to go ahead and allow the tariff revenues to remain in the U.S. Treasury. That would be the trade-off. So you don't have to worry about a sudden borrowing need on the part of the U.S. Treasury to come up with the funds needed to pay back to affected parties the tariff revenue. One thing that I'm struck by, however, is that, the previous meeting was on December 10th, 2025. And since December 10th of last year, we've actually had the 10-year Treasury yield move higher. It went up from 4.13% right now, 4.26%. And if you look at the TIPS contract, the inflation-adjusted Treasury yield contract, if you like, from this you can infer that inflation expectations have risen from about 2.32% back in December 10th. They're at 2.45% today. Inflation risks have not gone away. And we can see worry about inflation in this record high price for gold, surging prices for silver. We see this also in the industrial commodity prices, and the price of copper is up by a very large percentage, more than 20% from a year ago. I think the only industrial commodity down in prices is maybe oil. And if that were to start to increase along with a weaker dollar exchange rate, believe me, it's going to be all the more difficult for the Federal Reserve to cut interest rates, regardless of who might be Fed chairman come this spring.
Interesting that you did have Waller be a dissenter, and we know that he's expressed that view, and so I'm sure he really would love to be Fed chair. How likely is it that Waller is named over Warsh and Reeder and Hassett, who seems to be out?
It's anybody's guess, I suppose, at this point in time. President Trump, if he's one thing, he's very unpredictable. So I wouldn't go out on a limb and say that there's a 50% chance that any of these potential candidates might be selected as the next Fed chair.
And
as I said, ultimately, the Federal Reserve has to listen to the market. And if the market is worried about inflation, then the downside, if any, for the federal funds rate will be limited. There's no escaping that, especially since you're also now looking at a weakening dollar exchange rate. Well, that may not bother Donald Trump, but that would be of great concern to participants in the Treasury bond market, where more than 30% of outstanding Treasury bonds are held by foreigners.
Yeah, at that point, right? And, the other thing is, even though you made the point, the Fed cut 3 times at the end of last year. The last hold time was July, when we got a hold like what we just got now. After that, in the fall, we got 3 cuts. bond yields have been moving higher, not lower. I mean, we went below 4 just briefly. And so, there are people who come on and say, look, we could see 4.25, which we have right now, 4.50. When do you start to see, even though the Fed's cutting, could you be seeing rates go higher? And are you worried about that? If we're at 4.5, what does that mean to you?
Well, look at it this way, Nicole. There are people in the Trump administration that are talking about real economic growth for 2026 at of 4% or higher. Very rapid economic growth. And given the fact that we have a relatively firm labor market, given the fact that we have a lot of companies that complain about a lack of qualified labor, my goodness, if we're even going to have 3% growth or faster, we're probably going to run into a problem with wage inflation and price inflation quickly enough. So it well might be that by the end of 2026, if we have this rapid economic growth, we'll be looking at a federal funds rate that is higher than today's 3.63%. I think if you want to get inflation under control in a convincing manner to open the way for a 0.5 percentage point reduction in Fed funds, you've got to have a slower rate of growth for consumer spending. You've got to have a slowdown by GDP growth. And, according to some, that's not going to happen. The opposite is going to happen. So brace yourself for higher than expected interest rates.
That's the whole thing, right? I mean, mortgage apps were down. Today, everybody's waiting for better mortgage rates. And I guess whenever it dips below 6, they come running. But they're not seeing that too often. John Lonsky, thank you. President Lonsky.
Thank you, Nicole.
Great to see you. Happy New Year. My old friend, John Lonsky. We've known each other forever. All right, coming up next, the Fed and Art Hogan, another great one, B. Riley's Wealth Management. So I can't wait to hear what Art has to say about this. And at 2:30 p.m. Eastern Time, make sure you are paying attention because Jay Powell will come to the podium and we want to hear exactly what words he says in this press conference. It's crucial. We'll be right back.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Yeah, my mom was worried about me. The road should be better, but I don't know about this one either. It's coming though. She
Real-time access, data-driven analysis from U.S. equities to global macro matters. Schwab Network connects the dots. Watch live. Subscribe free at schwabnetwork.com.
All right, welcome back to the Watch List. I'm Nicole Petalides. We're live on the floor of the New York Stock Exchange. As expected, the Fed leaves rates unchanged after 3 cuts last year. And we're waiting for Jay Powell's press conference, which is live at 2:30 p.m. Eastern Time. And we'll bring that to you live the minute he walks out. In the meantime, it's my pleasure to bring in Art Hogan, Chief Market Strategist of B. Riley Wealth Management. So glad you are with us. In moments, we are going to hear from Jay Powell. Are you listening for anything in particular? What might he say or not say?
Yeah, Nicole, great to see you. I think this is the only exciting part of Fed Day. It was obvious they weren't going to cut rates. The 2 dissenters were relatively obvious. Miron's been on auto cut since he got his seat, and the other dissenter is still auditioning for the chair's position. So I think we're in a position now that the excitement comes in the presser, not in the statement, which we already have. And I think the presser is going to be all about how do you feel about Fed independence, How do you guard against that, and how far are you willing to go to make sure that we're there? So I think around those types of issues, and I think the secondary and more important questions would be, what does it take to get you, or how far are you from neutral, and what does it take in economic data, in the economic data stream, to get you to cut again? Are you leaning towards cutting again? I think that seems to be the consensus, but I think the big news would be, are you ready to say we have enough clear evidence that we're neutral, or we actually need to move again?
Yeah, I think about maximum employment. When they say maximum employment, we're not far off. I mean, if you have slower hiring and things like that, they don't seem to be particularly worried. They said the unemployment rate has showed some signs of stabilization. In fact, also adding the U.S. economy experiencing solid growth and inflation somewhat elevated. But so none of these things say rate cut, do they?
No, they really don't. The labor market and the labor mandate has been the one they've been defending. We just don't have enough clear data as to how many jobs we need to create on a monthly basis to keep unemployment in check. A year ago, we'd say 150,000. This year, maybe 50,000. We're creating about 29,000 jobs on a monthly basis over the last 3 months. So somewhere in there lies the truth, because our population growth, 11 million baby boomers retiring every month. You've got net zero immigration. So we have to figure out, and I don't think they have enough data to know, yes, this is what we need. If we started creating between 25 and 50,000 jobs, unemployment remains unchanged.
Yeah, understood. I'm looking here now at the big board right now. The Dow's down about 7, the S&P 500 down about 6. These are the levels where we've been over the last half hour or so. So we really didn't see too much market reaction. I mean, we've had back and forth action all day long, red and green, and the VIX has been sitting around this 1663. I mean, the only thing that really sort of changed is that the gold purchases went back up again, right? We were up $195. Now we're up $213. So people are still looking to the safe haven of gold. But the question is, as we hit this 7,000 mark, I think about, for example, one of the traders here said, look, I really need to see more from the tech stocks to really feel confident that, we're not toppy or too much CapEx spending to get above 7,000 and stay there. What say you?
Yeah, I think, Nicole, one of the good things is we're going to hear from the tech stocks, most of them this week. A good slug come out tonight. I think the good news is the multiples on all the Mag 7s have come down, and yet the market is still trading higher. And I think the earnings estimates that we've seen for 2026 have already gone up, with only about 100 S&P 500 companies reporting so far. So I think we're in a place where we can depend on earnings growth versus multiple expansion. And if, in fact, we start to hear from some of the hyperscalers, like we will this week, about not just how much they're going to spend on CapEx, but how they're going to monetize these investments, I think we'll be in a much better place in terms of comfort level of this market. But I think the broadening out of this market with 5 sectors outperforming communication services is something we haven't seen in 3 years, puts us in a much healthier place. And the Russell 2 small cap outperforming is also a huge positive for markets right now.
Yeah, let's go over those types of picks or opportunities a little more. So you went through just some different sectors there, some different groups like small caps. Where do you see opportunity in this market for 2026? What are you buying?
Look at some of the things that outperformed in the fourth quarter. I think they'll continue in the first half of this year. I think small caps is one of those. I think the equal weight S&P 500, which has outperformed since the beginning of the fourth quarter of last year into this year, is going to outperform the market cap weight S&P 500, and that's good. I also think the industrials, which were a big performer last year, continue again this year. But I think the two that haven't yet performed this year that will likely play the most catch-up is going to be healthcare and financials. Both of them are going to be beneficiaries of a lighter regulatory touch and the likelihood that interest rates are heading lower this year than higher.
Yeah, so you sometimes look to the laggards or the dogs and look for them to be the winners. Is that like when you talk about the rotation? Because rotation has been somewhat widespread, right? It hasn't been just to bleeding wet.
It hasn't been, and that's positive, right? So 23, 24, and 25, all about tech and communication services. The beginning, ChatGPT rolls out, AI revolution starts. Everyone wants just 2 sectors, tech and communication services. That was fine for them. For now, it's what else is artificial intelligence adjacent? Who's going to improve their productivity because of artificial intelligence? And what is this environment with steady economic growth, lower interest rates, and less regulation going to help? And those are the sectors I think you want to start taking a look at. Financials sit right there at the tip of the spear. I certainly think that the healthcare industry in general is going to see a lot of consolidation, and the regulatory touch there certainly helps. So sectors that if you were looking to broaden out your exposure to the markets, those would be two places I'd be looking.
Yeah, I mean, and overall, you think we're higher at the end of the year than where we are now, right?
Yeah, if you take the average consensus estimate for the S&P 500 earnings for 2026 and use the same multiple on a trailing basis that we've seen for the last 5 years, it's not much of a math to get to 7,600, 7,700 on the S&P 500. I don't think it's going to be a straight line. There's plenty of things that are going to cause volatility. The Supreme Court could throw back the tariffs and the constitutionality of using the Emergency Powers Act. We could go through a midterm election cycle that might cause some volatility. But I just think it's all about earnings, and consensus for this coming year is going higher, not lower. That happened after the third quarter earnings reporting season, and is continuing to happen in this earnings season.
And we love seeing your dogs on Twitter. Are they Congress Bengals or Cavaliers?
They are Cavalier King Charles, and this one wanted to join as part of the dogs of the Dow. I had to pick him up so he stopped barking during the interview.
No, that was good. I think he was whispering the answers in your ear, Art. All right, thank you.
I'd be lost without him.
I know they are your analysts. Very cute. Thank you. Art Hogan, it's always a pleasure to see you. Thank you so much, and a Happy New Year to you and the gang there at B. Riley Wealth Management. Thank you, Art Hogan. So we're waiting for Jay Powell's presser at 2:30 p.m. Eastern Time. That'll be live. George Sillis is joining me now, and we're talking about really what we've heard from the Fed and what we could surmise from this part thus far before the presser comes out.
Well, interesting. The market reaction has really been not much at all, even in the yield complex, the equity complex. So clearly, the market is still waiting on the Q&A coming out in the next 20 minutes or so altogether. So I think everyone's going to be looking for some comments on inflation progress, labor market tone, if you will. They did denote that the economy is expanding at a solid pace. Unemployment has slowed down in terms of the risk of the labor market. I think that's interesting. They seem to be more bullish on the economy. And of course, the inflation risks are something we're going to be looking for in terms of even the dollar, which has actually been moving to the downside over the past week, which can, of course, be inflationary considering some pickup in areas like crude oil, which is, again, something that translates into inflation. So, again, the commentary in terms of where the outlook from Jerome Powell going forward is going to be important. And then, of course, what's going on with the dual mandate. The other thing I'll be looking forward to myself, I'm sure somebody will ask a question associated with this, is the reserve management policy. There are $40 billion a month purchases, which actually have helped improve the amount of reserves on the bank's balance sheets to about $2.9 trillion. They were below that level, around $2.8 trillion, just going back to December of last year when they started this program. So that's, again, very supportive of the markets. But nonetheless, you have to consider, too, Nicole, that right now, based on federal funds level that we're at, with no change after 3 consecutive declines, pretty much in line with 2-year yields, which have not moved at around 3.58% since the announcement just a few minutes ago.
All right, so now we have to wait and see because, the dissenters, first of all, Myron did 25 basis points rather than 50. Yeah. I mean, I don't know what happened. I don't know what made him say 25 and not 50. The other thing is Waller, who said 25, and he's in the running for Fed chair.
Right. So there are 2 dissents, and again, both the dissents were expecting or would have liked to see a 25 basis point cut. One of the things you have to keep in mind, the consensus is, of course, the majority, which is what we're seeing in terms of no reaction nor cut today. Nonetheless, if you do look at some of the ratios, even including the SEP report last meeting, right now we're about 1% above inflation in terms of the federal funds rate. And that's what their neutral rate is expected to be in the long run. In other words, the expectations of 2% inflation and about a 3.1% federal funds rate. So we're pretty much in line with longer-term expectations. And so, again, even if we get to those levels, that would only include in the next couple of years, or even the long run, only 2 interest rate cuts. So we're already at a low level contingent upon inflation. So there's not a lot of wiggle room unless there's some sort of crisis that the Fed has to lower rates more than, let's say, 50 basis points between now and, of course, their long-run goals.
Yeah, and you know what I think about? I think about that we have both monetary policy and fiscal policy sort of working for folks. We did see that the U.S. economy is now experiencing solid growth, was among the first lines of the Federal Open Market Committee statement. And Jay Powell will be coming out in a moment. But when you have tax cuts and you have businesses feeling like they're doing better, you have earnings that are showing fundamentally that they are improving, and monetary policy that's been somewhat, they pulled back 3 times in the, back half of the year, 2 more maybe to come. So people feel that things are lined up. Final quick thought, George, because Jay Powell's coming out.
Yeah, sure. Yeah, I think if you just consider the nature of interest rates being elevated, that could be a sign of either inflation or some combination of high investment demand. And that's what we're actually seeing with non-residential investment spending being extremely robust. I know the housing market struggled, but that's why I emphasize non-residential. Business fixed investment spending is very, very much in demand, and that could also be why interest rates are remain high, which is a good reason for higher interest rates, not necessarily a bad one.
And it's worth noting, thank you, George. It's worth noting we did hit a record earlier today in the morning. We got up to 7,002.28. We're 1 year for the S&P 500, up 15%. Year to date, up just over 1.7%. But some of these here's Jay Powell coming out right now, our Fed chair.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The U.S. economy expanded at a solid pace last year and is coming into 2026 on a firm footing. While job gains have remained low, the unemployment rate has shown some signs of stabilization, and inflation remains somewhat elevated. In support of our goals, today the Federal Open Market Committee decided to leave our policy rate unchanged. Having lowered our policy rate by 75 basis points over the course of our previous 3 meetings, we see the current stance of monetary policy as appropriate to promote progress toward both our maximum employment and 2% inflation goals. I will have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a solid pace. Consumer spending has been resilient, and business fixed investment has continued to expand. In contrast, activity in the housing sector has remained weak. The temporary shutdown of the federal government likely weighed on economic activity last quarter, but these effects should be reversed as the reopening boosts growth this quarter. In the labor market, indicators suggest that conditions may be stabilizing after a period of gradual softening. The unemployment rate was 4.4% in December and has changed little in recent months. Job gains have remained low. Total non-farm payrolls declined at an average pace of 22,000 per month over the last 3 months. Excluding government employment, private payrolls rose at an average pace of 29,000 per month. A good part of the slowing in the pace of job growth over the past year reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Other indicators, including openings, layoffs, hiring, and nominal wage growth, show little change in recent months. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index indicate that total PCE prices rose 2.9% over the 12 months ending in December, and that excluding the volatile food and energy categories, core PCE prices rose 3.0%. These elevated readings largely reflect inflation in the goods sector, which has been boosted by the effects of tariffs. In contrast, disinflation appears to be continuing in the services sector. Near-term measures of inflation expectations have declined from last year's peaks, as reflected in both market and survey-based measures. Most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 3.5 to 3.75%. Since last September, we have lowered our policy rate 75 basis points, or 0.75 percentage point, bringing it within a range of plausible estimates of neutral. This normalization of our policy stance should help stabilize the labor market while allowing inflation to resume its downward trend toward 2% once the effects of tariff increases have passed through. We are well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. Monetary policy is not on a preset course, and we will make our decisions on a meeting-by-meeting basis. To conclude, the Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We at the Fed will continue to do our jobs with objectivity, integrity, and a deep commitment to serve the American people. I look forward to your questions.
Christopher Gaber at Associated Press. Thank you. I wanted to ask that you attended the Supreme Court hearing last week on the Lisa Cook case, and Treasury Secretary Scott Bessent criticized that as political. Can you say why you attended and what you would say in response to the Secretary's criticism?
So let me start with I don't respond to comments by other officials, whoever they may be. It's just not appropriate to do that. I will tell you why I attended. I would say that that case is perhaps the most important legal case in the Fed's 113-year history. And as I thought about it, I thought it might be hard to explain why I didn't attend. In addition, Paul Volcker went to a Supreme Court case famously in, I guess, 1985 or so. So it's precedented, and I thought it was an appropriate thing, and I did it.
Great. And then just quickly follow on the job market. You mentioned last month that the household survey might be distorted, and you also mentioned the potential for overcounting jobs, which would suggest that we're still in a negative hiring pace. So do you see the drop in the unemployment rate as solid? And what's the basis for saying that things have stabilized? Thank you.
So, yeah, really two questions. One is, so we're getting through the distortions in the data from the shutdown. However big they were in November, they're smaller in December. So we're getting to a place where they're no longer material. They're still there, but it's a tweak here and there. The reason why we changed the statement, let me pull it out, was simply it used to say that judges that downside risks to employment rose in recent months. So we saw data coming in which suggests some signs of stabilization. I wouldn't go too far with that, but some signs of stabilization. There are also some signs of continued cooling, and so we thought that was no longer an accurate description of the data. In addition, the outlook for economic activity has clearly improved since the last meeting, and that should matter for labor demand and for employment over time. So for those two reasons, we thought we would take that language out of the statement.
Nick Timmer's, The Wall Street Journal. Chair Powell, you've generally avoided engaging with political controversies directly, and the video statement on January 11th was a departure. What made this different, and are you concerned it could draw the institution further into political debates?
So today I'm simply going to refer you to the statement that I made on January 11. I'm not going to expand on it or repeat it. So I'm just not going to. This is really about the press conference and the economy and what we did today, and some ancillary. I'm not going to be getting into that.
Can you say whether the Fed has responded to the subpoenas?
I have nothing for you on that today.
Michael McKee from Bloomberg Radio TV. Have you made a decision on whether you would remain as a governor of the Federal Reserve? And if so, would you tell us what it is? And if not, when might we anticipate a decision?
No, and I really, once again, have nothing for you on that today. That either.
would you want to leave it all under the circumstances?
Again, I don't want to get into this. Not something I'm. There's a time and place for these questions, but not something I'm going to be getting into today. Thank you.
Thank you. Claire Jones, Financial Times. Thanks a lot for taking my questions. In another one that might, lead to a similar answer. We've seen quite big movements in the dollar over recent days. What do you think is driving the US currency lower? And have you been at all concerned just by the extent of the volatility we've seen this week? Thank you.
So, Claire, as you probably know, we don't comment on the dollar. Really, the administration, especially the Treasury Department, has the job of oversight over the currency and exchange rates and all that. We don't comment on that. It's not our role. So I have nothing for you.
But what's your view on the market movements? What do you think behind them? Is it asset managers diversifying? Is it?
Yeah, I just don't. We don't talk about the dollar. We don't talk about what moves it around. It's just not appropriate for us to do so. Really, the Treasury Department has that. It's their role, their bailiwick, and we stay off it. We do monetary policy and some other things, but we don't comment on the dollar. Sorry.
Hi, Chair Powell. Neil Irwin with Axios. Obviously, no SEP in this meeting, but in light of the slight firming up of the language around growth in the labor market in the statement, should we assume that the timeline for any further rate cuts is pushed back compared to what people might have thought in December?
Well, first of all, if you look at the incoming data since the last meeting, clear improvement in the outlook for growth. The data have come in, and sentiment, the beige book, everything comes in suggesting that this year starts off on a solid footing for growth. Inflation performed about as expected, and as I mentioned, some of the labor market data came in suggesting we're evidence of stabilization. So it's overall a stronger forecast. It really, if that's your question. I'm not sure I answered your question.
But in terms of timing or pacing of any additional easing,
so we haven't made. What we'd say about this was that after this meeting, after the 3 recent rate cuts, we're well positioned to address the risks that we face on both sides of our dual mandate, and we'll continue to make our decisions meeting by meeting based on the incoming data, the implications for and the outlook and the balance of risks. Haven't made any decisions about future meetings, but the economy's growing at a solid pace. The unemployment rate has been broadly stable, and inflation remains somewhat elevated. So we'll be looking to our goal variables and letting the data light the way for us.
Steve Leisman, CNBC, and sticking with questions you might answer. Thank you. You had previously, I believe, described the current policy rate being at the higher end of neutral. And if you look at the longer run, the SEP and the longer run rate, 16 of 19 officials are actually below there on their long run. Is the Fed still in a process of bringing it down towards a middle range of neutral? And what would it take to get there?
So the count I did was that 4 of the 19 were at or above that. Maybe I missed by one, but I thought it was 4. And if you look at the dealer survey, it was 10 out of 58 where we're at or above. So you're right. It's the higher end of the range. What we say is it's within the range of plausible estimates. This is the higher end of that range, but so for some people they think it's neutral. I think, and many of my colleagues think, it's hard to look at the incoming data and say that policy is significantly restrictive at this time. It may be sort of loosely neutral, or it may be somewhat restrictive. It's in the eye of the beholder, and of course no one knows with any precision. So
what you see?
You had a follow-up.
I get what you're saying, but some officials have described the Fed being in a mode of bringing it down eventually over time. Are you still in that mode, or is this a place to hang out?
Yeah, no, I would say if you look at the SEP from December, most people had additional normalization. But at the same time, we've done a lot of the process of normalizing. A good piece of it is done with 75 basis points, and before that, 100. It's 175 basis points we've cut since we began cutting in September of 2024. So you So you've moved a good way, and we think we're well positioned here to watch how the economy performs, look at the data. We're not making decisions about future meetings, but we do think we're well positioned after those three cuts to let the data speak to us.
Thank you, Chair Powell. Amara Mobley from Bloomberg News. To what extent did the committee discuss the possibility of cutting at this meeting or in March? And how are you all thinking about the conditions that would merit another rate cut? Is there broad agreement on the committee about what it would take?
So there was broad support on the committee for holding today. Broad, I would say, including among non-voters. So that's where that was. Of course, some people did want to cut and dissented, but committee pretty broad
I like how RR is
for holding today. We're not trying to articulate a test for when to next cut or whether to cut at the next meeting. What we're saying is we're well positioned as we make decisions meeting by meeting, looking at the incoming data, evolving outlook, and all that. And we're in a position where we still have some tension between employment and inflation, but it's less than it was. I think that the upside risks to inflation and the downside risks to probably both diminished a bit. So we'll be looking at that. It's about how you weigh the risks to the two goals and how big those and quantify them. And so there are different views on the committee, and we'll find our way forward as the data evolve.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. Has the effects of tariffs already moved through the economy on prices?
A lot of it has. So basically, there are many different estimates, and they're all highly uncertain. But most of the overrun in goods prices is from tariffs. And that's actually good news, because if it weren't from tariffs, it might mean it's from demand, and that's a harder problem to solve. We do think tariffs are likely to move through and be a one-time price increase. So most of the overshoot, if you were to take that out, inflation, core PCE inflation is running just a bit above 2%, x the effects of tariffs on goods. And the other good news is, if you look away from goods and look at services, you do see ongoing disinflation in all the categories of services. So that's a healthy development. So that's what's going on. The expectation is that we will see the effects of tariffs flowing through goods prices, peaking, and then starting to come down, assuming there are no new major tariff increases that are begun. And that's what we expect to see over the course of this year. If we see that, that would be something that tells us that we can loosen policy. Also, if we see something that suggests that the labor market is not stabilizing, that in fact the downside risks reemerge or the data just get worse, we'd have to look at both of those. We have a two-sided mandate.
If I could, if President Trump does pick a new Fed chairman before May, what does that look like? How would you work with that person, and what does that transition period look like?
I don't have anything for you on that. That will depend on Congress's actions and things I can't speculate on.
Howard Schneider with Reuters. Thank you for taking our questions. Given the changes in the statement and all you've said so far, is it fair to describe risks to both sides of the mandate as roughly balanced right now? And is the next move necessarily down?
I'd say that the upside risks to inflation and the downside risks to employment have diminished, but they still exist. So there's still some tension between the mandates. Are they fully in balance? Hard to say. And we think our policy's in a good place. I've just discussed reasons why we might change our policy, and we'll just have to see how the data lead us.
I'm wondering, you a minute ago you said you felt expectations were consistent with your mandate, that the 2 and the 10-year break-evens have moved quite notably in the last couple of weeks, I believe. Is there any concern on that front?
I mean, I recently looked at all of the both survey and market-based short-term inflation expectations have come way down. They were in a good place at the beginning of last year. They spiked around Liberation Day. in the last few months, so that's very comforting. And the longer-term inflation expectations have remained in places that are very consistent with 2% inflation over time. So expectations have been solid, and they reflect confidence in the return to 2% inflation.
Apologies if this is a little bit repetitive, but in the past you've said that the reason you cut rates was that the risk to the labor market was greater than the risk to the inflation side. Is that still true?
We haven't made. You're right. We saw the labor market weakening, and we acted. And I think that was the appropriate thing to do. We will always act to address what we see as the economy moving away from our goals. Risks to both of the variables are a little less. I think the upside risk to inflation, again, a little bit less, and the downside risk to employment, a little less. I just would say that I'm not making a judgment about how one of them is more at risk than the other, just that the risks to both of them have diminished.
Okay, thanks. BIS wrote a paper last summer which concluded that global investors were hedging their dollar exposures in ways that previously they hadn't because of policy uncertainty. Do you agree with BIS?
We really don't see much at all about that whole story. There's just not a lot of data that suggests that there's much to that.
Thanks.
Anna Swanson with the New York Times.
Welcome back. I'm Nicole Petalides, and we are live on the floor of the New York Stock Exchange. I bring back George Sillis, senior markets correspondent. We were just listening to our Fed Chair, Jay Powell, and there were things he said very clearly and things he stayed away from very clearly. I'll just go through a couple of them, and I think the most notable is how well the economy is doing. Firm footing, solid growth, solid pace, and also the turnaround in the labor picture. He took out the phrase about downside risk rose in recent months to unemployment. Now we're getting more about unemployment. Now the unemployment rate has shown some signs of stabilization. So the downside risk is out. Housing is a bit weak. Business investment spending is okay. He doesn't know whether or not he's going to stay on or didn't share that with us. That's more. Tariffs are digested, and the data is now pretty much materialized to be cleaner after what we saw with the Fed shutdown with the market shutdown, the government shutdown. Now they have more data to go on. Your thoughts, George?
Yeah, I think if you look at how he described the labor market, it was duly noted that they talked about private payroll growth. There was some challenges because of the government shutdown in federal government labor markets. And ideally speaking, too, if you look at what's going on with inflation, I think this is important because service inflation or services is about 70% of total output of our consumption-based economy. So essentially, he's noting that service inflation is down, but unfortunately, goods inflation has picked up based on tariffs over the last, 8 or 9 months or so. And if that seems to be being addressed going forward, that could actually bring that inflation rate down closer to the annual expectation rate this year in 2026, based on their last projections around 2.5%, which is about 50 basis points lower than what he denoted as core PCE inflation all of 2025 at 3%. So the more inflation comes down, they're going to realign their rates relative to inflation. Right now, they're still about 1% in the federal funds rate relative to inflation based on last month's reading of the core PCE. And again, if you look at the expectations for rate cuts this year, it looks like they're penciling in one rate cut, perhaps in June, and that is going to be contingent upon inflation moving gradually lower. Labor market conditions, I think he's very bullish on the labor market in terms of stabilization. He readdressed some of the other facets of the labor market he talked about last meeting, which includes, restrictions on immigration, labor force participation. Those two numbers have actually created some softness in the labor market. But going forward, especially on the recent data, seems very optimistic in the labor market. Plus, GDP has actually shown to be really resilient, especially, and a lot of people don't talk about the trade balance. The Trump administration's policies have re-onshored production in the United States, and actually the trade deficit is narrowing, and that's very accretive So bullish on the economy, bullish on the labor market. And I can see their position right now with the federal funds rate where it's at relative to inflation, because there's some questions, and one of the participants asked the question about the neutral rate, and they basically talked about how, or he did talk about how the neutral rate right now is on the higher end of the range, which is a little bit over 1%, and that range is typically between 0.75% and 1%.
Yeah, that's interesting. I mean, it was interesting to talk about how most of the folks thought that. He also said most of the folks voting and non-voting were in the hold camp. What did you think of that?
Well, I do think that's relative to what we're actually looking at from a measurement standpoint. Inflation to federal funds rate, again, stable labor market, stable GDP. Most participants should do exactly what they did, which is on a holding basis. Again, there was 2 dissents, 25 basis points, which again is not much relative to where we were and where we're at. So rates are already moving down or have moved down significantly. The question is how much room do they have more to reduce them absent, some stress in the economy? There's not much room, again, because they're very close to assuming 2.5% inflation this year, close to their benchmark goal of 2%, and they're penciling in essentially only 2 more rate cuts between now and their long-run rate. So again, one this year, perhaps one next year or the following year, but that's it, unless there's some other exogenous stress in the economy that causes them to react to a challenge from a monetary policy standpoint.
Yeah, and while Jay Powell would not give us a glimpse into his future with whether or not he'll stay on as a governor, he made it clear why he attended the trial there for Lisa Cook and how important that was. But the big picture here is that the labor picture was improving, right, rather than being downside risk, and the inflation story was also sort of tepid, and so we're okay, slightly elevated. So it seems that for right now, the Fed stands put. George Silas, thank you so much for going through all of this. This is, as the Fed chair continued to say about the U.S. economy, on firm footing and experiencing solid growth. And with that, you're not really going to see a rate cut. Not today. We didn't. So there you have it. I'm Nicole Petalides. So glad you are with us. Markets really haven't moved too much. Nothing too notable to share with you on that. But it is worth noting that we hit 7,000 on the S&P. So a lot to watch between now and the closing bell. We bring you right back to our special Fed coverage live in Washington.
Come to essentially a halt from a fairly fast clip of growth over the last couple of years, driven by immigration, and then the halt being driven by a very sudden stop in immigration. So many outcomes were possible with that. Supply came way down. It turns out that demand for labor also came down a very similar amount, maybe just a little bit more, which is why the unemployment rate has gone up. So I don't know whether that's a coincidence or not, but that's what's happened with that part. But if you look at other things, like, for example, just to pick a couple, the Conference Board's measure of job availability that came out, I don't know, was it yesterday or today? But, it shows, it's a survey showing that workers feel like job availability it's a very low reading. It's just one reading, but it's an indication of softening. People, part-time for economic reasons, which is a category within the broader U6 category measure, has moved up significantly. So there are lots of, I could go on and on, there are lots of little places that suggest that the labor market has softened. But you're right, part of payroll job softening is that both the supply and demand for labor has come down. Growth in those two have come down. So that makes it a difficult time to read the labor market. So imagine they both came down a lot to the point where there is no job growth. Is that full employment? In a sense, it is. If demand and supply are in balance, then you could say that's full employment. At the same time, do we really feel like that's a maximum employment economy? It's very challenging and quite unusual situation.
Thanks. And one more on
So essentially, the economy has once again surprised us with its strength, not for the first time. Consumer spending, although it's uneven across income categories, but consumer spending overall numbers are good, and we're benefiting from the AI build out of data centers. That's another thing we're benefiting from. But the economy overall, the growth is on a solid footing. It looks like, and it's not just those things. It's just the consumer is filling out surveys that sound really negative, and then spending. So there's been a disconnect for some time between downbeat surveys and reasonably good spending data.
Thanks, Chair Powell. Christine Romans from NBC News. You talked about how consumer spending is uneven. The president calls inflation defeated and solved. The FOMC says it's a somewhat elevated inflation. But you talked about those customer survey or those consumer sentiment surveys and public opinion polls that show that most families say the cost of living is still issue number one. What is the conversation around the table with your colleagues about how wealthier consumers seem to be driving so much of the economy, and why so many families still feel like they just can't make ends meet after 5 years of rising prices? What is that discussion like?
So a couple things. One, there's something to it in that we know that higher income households that tend to own real estate and tend to own stocks, securities, and those assets have been going up in value, and increases in wealth do support spending over time. So, and that's clearly a part of the story. We also know that for some time now, for a year or more, we've been hearing from retailers, for example, that serve lower income customers, whether it be food or the big box stores or anything. They're saying the same thing, which is our consumers are looking to economize. They're trading down from brands, and they're buying less, and it's changing their buying habits and that kind of thing. So we're seeing that, and that is a reality of what we're seeing. They're still consuming, but they're feeling it in a different way. I would say more broadly, affordability. We have a vast network through the reserve banks and also through the Board of Governors, where we talk to small and large businesses and households, and so we do hear a lot about affordability, and we take that very seriously, and we take it to heart, because one of our jobs is price stability, and so the best thing we can do for people who are feeling that squeeze is to keep inflation under control, and frankly, to finish the job of getting inflation back down to 2%.
You mentioned the AI build out.
Good afternoon. It's 2 p.m. on Wall Street, and this is Market on Close. We've just gotten the FOMC's decision to leave rates unchanged for now. I'm Marley Caden, coming to you live from our Chicago headquarters.
And I'm Sam Bidas, coming to you live from the floor of the New York Stock Exchange. Let's take a look at what is coming up on today's show. We will have plenty of reaction to today's rate decision to keep rates on hold. We'll break down that announcement and Powell's press conference and where the Fed goes from here. Later, we'll be joined by the CEO of Virtuix after its debut on the NASDAQ. We'll learn all about its omnidirectional treadmills, yes, you heard it, that let users walk and run in 360 degrees inside AI-generated worlds. And after the bell, of course, we'll have earnings from Meta, Microsoft, and Tesla. We'll react live to the numbers as soon as they are released. Marley, there is so much on the tape today. Just talk us through some of the top stories that stood out for you.
Yes, so much, Sam, but Seagate, of course, standing out as the top performer in the S&P 500 today after posting stellar fourth quarter results. The company reported significant beats on both the top and the bottom lines, as well as far better than expected guidance for the current quarter, citing what they called exceptionally strong demand. Also, Starbucks moving higher post-earnings after reporting mixed results. Fourth quarter revenue beat expectations, but earnings missed. Coming up short, margins also remain under pressure. The positive reaction, although they've given back some of the gains, still in positive territory, stemmed from the coffee maker's progress in its turnaround plan. Transactions growing for the first time in 2 years, alongside its second straight quarter of same-store sales growth.
shared its first financial outlook since last year. And lastly, Amazon laying off more workers. The company says it plans to eliminate about 16,000 corporate jobs. That marks its second round of mass job cuts since last October. Those 30,000 collective cuts since October represent about 10% of its corporate and tech workforce. Amazon has about 1.5 million employees, primarily made up of warehouse and logistics workers. Now, lots to get to today. There were so many big stories. But before we do that, let's take a look at how the markets are reacting in the wake of the FOMC decision. And most of the same picture we've seen throughout the day. The market's looking for some direction here. S&P's zeroed out. We are below that 7,000 mark after hitting that record earlier today, 69.78. The NASDAQ is higher, getting a boost from some of these chip names, 26,054.89. Seagate also helping their rise. On the Dow, we're at 49,000 unchanged, essentially, and the Russell 2000 slightly lower on the day, down 0.25%, 2660. On the 10-year, we are moving up a bit. We are now at 425. The dollar at 96.21. Gold back above that record. I think this is in fact a new record, 53.64.70. That's up 4 3/4%. Crude oil rising as well, about 1.5%. Now we're at 63.33 a barrel. And Bitcoin 89,510. It is rising, but still can't seem to get over that 90,000 mark. It's been stuck under for days. Sam, I would love to know what stories are catching your eye, because as you mentioned, no shortage of things for us to talk about today.
No, and obviously the biggest one coming in the last half an hour or so, this reaction to the Fed decision. Obviously, as you mentioned, not a lot of change as far as equities are concerned. A little bit of a move on the 10-year yield, but the Fed Watch advisors coming out calling this a bullish, hawkish statement, obviously with that pause, but more around the upgrade to the economy here with the outlook for activity, him saying it's clearly improved, which should matter for employment. That, of course, according to Fed Chair Jerome Powell, data suggesting things have started on solid footing for growth. So the growth outlook is looking better, and particularly when you look at more of the neutral statements here around the dual side of the mandate. Obviously, the shift in balance of risks, removing that downside risk when it comes to labor, less worried about both sides here. But the risks, Jerome Powell saying, still existing here. They're going to wait and see. The decisions are going to go meeting by meeting. 2 dissents, obviously, from Myron and also for Waller. So they were the major takeaways, but not a huge movement as far as the markets are concerned. Obviously, waiting for that next big catalyst with those earnings. But the dollar stabilizing this morning after hitting a 4-year low and experiencing its worst drop since April. And it came after Treasury Secretary Scott Bessent said the U.S. has a strong dollar policy. He also said that the U.S. is absolutely not intervening to prop up the Japanese yen after recent speculation about some rare coordinated intervention. The yen did tumble off the back of that. Now, President Trump had earlier weighed in on the dollar, suggesting he's not worried about the weakness, saying, I think it's great. Look at the business we're doing. Now, the Dixie did fall over 9% last year. Remember, the Japanese yen, which I mentioned, has been a big beneficiary of a weaker dollar. That slid on the news. We also saw a move in the metals, which gave up earlier gains. Remember, gold setting another record this morning above 5,300, also on the softer greenback, but then paired gains ahead of that FOMC meeting. Silver making a similar move after hitting a record of 117 on Monday. So plenty of movements across the FX space and also the metals today. But Marley, I'll send things back over to you and Jenny Horn in Chicago with some of today's top movers.
Thanks so much, Sam. Yes, Jenny Horn, co-host of Next Gen Investing, joining us here in Chicago to help break down some of these top movements we've seen. And of course, the biggest move we've seen came from Seagate in the wake of this earnings report. They had blockbuster earnings. They were up more than 20% when we last spoke about them on your show on Next Gen Investing. Take us through this report and why we're seeing such a big move to the upside for a stock that has already made huge moves to the upside.
Well, I feel like one thing we've learned from this earnings period is that the headline numbers really don't matter as much. At least that fits the bit today. Obviously, this narrative can change. I mean, you have 53% bottom line growth and then 21% bottom line growth. Margins also healthy, but that doesn't really illustrate the story, because hugely right now, as we're seeing these various AI applications and the overall modern data centers increasingly needing these storage solutions, this company has given not only cost efficiency, but also continued to perform in a, again, sometimes challenged overall supply chain environment. So giving really strong guidance, that was huge, as they expect now for the current quarter. Revenue at the midpoint to be around $2.9 billion. That was ahead of expectations. Operating and earnings is also well ahead of expectations now as far as their guidance was concerned. But they did highlight this 22% increase
see a move, but I don't know that we thought it would be a 20% move. I think the options market was pricing in about an 8% move in the wake of earnings, up or down for Seagate. But a good day for them. It puts them more than 60% higher just on the year so far for 2026. Also a good move to the upside for Texas Instruments, staying in a similar space in the analog realm, though, here. But Texas Instruments having another strong report as well. Good move. They were up more than 9%.
I mean, yeah, so this just goes to my point about, does the headline number matter? Because they did actually report fourth quarter results that missed expectations, but guidance seemed to be the point of reassurance. So, I mean, revenue missed $4.42 billion, earnings at $1.27 a share. I mean, barely missed, but it was still a miss at that. Revenue was still up 10%, but that really is not the entirety of the story, because you look at right now their forecast for their revenue for first quarter, it's expected to be around 4.3 to 4.68 billion. Now, at the midpoint, that would imply sequential growth, which was something called out actually by Cantor Fitzgerald. This would be the first time in more than 18 quarters that we have seen the fourth quarter to first quarter revenue actually improve sequentially. So that's kind of astounding. But the overall outlook helped offset concerns about, again, this headline miss. They do really focus on analog, embedded chip design, but have exposure to some of these more lackluster markets like automotive. But overall, the results, I think, were received pretty strong by the street. I did see a Bernstein note saying that the results were decent, but I think that maybe a sigh of relief after some of the volatility that we've seen in this name, frankly, underperforming the broader semiconductor space over the last 52 weeks.
Yeah, I mean, it is nice to see. This is a good example, as you pointed out, of guidance and how important it's going to be in this particular quarter, that's what a lot of eyes are on, seeing a huge move to the upside on guidance alone, because as you said, the numbers weren't as strong as expected. Pivot here to a non-earnings story, though, although we will be talking about Amazon next week. They are laying off more employees, announcing them in advance of their earnings statements.
And this is something that, first of all, I feel like there's a humanity element to this, where obviously this is a substantial portion of jobs. Amazon does this a lot. And so, I mean, to speak to that, we've seen pretty major overall just restructurings from an employee layoff and hiring perspective in not only post 2014 and this AWS shift, and then again in 2018, and then again, of course, 2019 and 2020, we've seen, I mean, major just overhauls as far as their workforce. So this is not a new narrative for Amazon, but planning to cut roughly 16,000 corporate jobs to streamline its organization. Its U.S.-based employees that will be affected will have 90 days to look for new roles, and as well as they will be receiving severance as well as other transitional support. But this was highlighted right now as really being able to help reduce layers, increase ownership, and remove bureaucracies. As they said, these changes will not necessarily freeze hiring by any means, as they actually directly stated they'll continue hiring and investing in other very strategic areas. And I will say that when you look at the pockets of hiring and firings, AWS, which is their high margin business, it's really what the street really cares about, has not really seen any faltering in the recent layoffs, because that's really where it seems like they're concentrating a lot of this focus, and there's a good reason why. I mean, it's, again, that high margin aspect of their business.
And Amazon moving down slightly, but I'm not sure it's tied to any of this layoff news. A marginal move to the downside today, about 0.5% for them. I do want to talk about Starbucks, though. They had their earnings before the open. Bit of a mixed quarter, but the comments I got today on Trading 360 was that it was positive in terms of the turnaround, seeing some response to that. We saw a really positive move in reaction to the results. They've given back most of those gains, though.
And I'm not surprised, because I do feel like these names that are fairly discretionary facing, and they're just not the growth story that right now is so dominated by tech. So I feel like it's almost just an appetite for risk and right now growth in this market that maybe is not playing out into these discretionary names. But first quarter revenue did beat the expectations. Global comparable sales, though, were up, or same-store sales, were up 4%, as we saw the U.S. specifically post its first comparable sales growth figure in 2 years. Management said the turnaround is now ahead of schedule, prompting many analysts to then raise their price targets. But so far, we've seen global comparable sales be a bit of a drag. I mean, we've seen most of their growth actually come internationally, even as the overall market in China does remain fairly, right now, crowded. But earnings miss estimates, and there is still, I mean, a lot right now of these pressures like coffee prices, overall macro concerns, and I just think that a consumer that is trying to tighten their belt, tighten some of that spending. But I will say, you look at Brian Niccol and what he's done for brands like Taco Bell, Chipotle, now Starbucks, all brands very near and dear to my heart, maybe Taco Bell a bit more than the others, but he has been able to really far, based on these advertising efforts and some of their holiday drink offerings and promotional deals, it does seem like this is resonating because foot traffic is also continuing to be higher, despite, again, some weakness in these metrics, which could be related to some, again, global macro pressures.
Yeah, still holding on to those gains, though, not as high as earlier, but overall, the sentiment seems to be that the turnaround is well underway. Thanks to Jenny Horn for breaking down those stories for us, co-host of Next Gen Investing here on the network. I do want to send it back to Sam in New York, though, for a look at what we have coming up in the rest of the show. Sam?
Well, we'll get back to the Fed, Marley, and what's next after they held interest rates steady. Market on close. We'll be right back.
What is that?
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Why are you saying that, bro? Why y'all saying
Real-time access, data-driven analysis from U.S. equities to global macro matters. Schwab Network connects the dots. Watch live. Subscribe free at schwabnetwork.com.
Welcome back to Market on Close. I'm Sam Vardas alongside Marley Cater. Let's dive into the Fed's rate decision and comments from Jerome Powell with our next guest, Christian Salamone, Chief Investment Officer of Atlas Rock Private Wealth. Hello to you, Christian. So obviously we got a hold as widely expected. Fed Watch advisors thinking that the commentary has skewed bullish, hawkish, particularly with respect to the upgrade to the economy, the upgrade to jobs, less worried about things on both sides of the dual mandate, avoiding questions around Fed independence, Lisa Cook, and the dollar. What were your takeaways?
I think it was exactly what the market expected. Maybe not what they wanted, but given the strong GDP numbers, employment continuing to show signs of improvement, as well as inflation, though still high, somewhat moderating. Powell even mentioned the fact that they expect to see later this year the transition of the cost of tariffs to be coming down, which is a good sign because it means there's not other parts of the economy that are causing the heightened inflation we have. And I think he's hoping that we get back down to their 2% target. Now, obviously, the meetings in the future and whether there'll be continued rate cuts or they'll start cutting rates again is going to depend heavily on the data. And he mentioned that more than once about their dual mandate between keeping unemployment low as well as keeping inflation low. And so, I think that the market from now on is really going to be watching both the labor market as well as inflation and whether the administration is going to be putting on new tariffs, which could certainly put a monkey wrench into some of the comments Jerome Powell made today.
And Christian, was there anything that surprised you either in the adjustments made to the post-meeting statement or anything specifically that Jerome Powell said in the press conference?
I wouldn't say that I was surprised. It's somewhat, like I said, I think this is what the market expected, given that the data has gotten a little bit better. I think it would have been very surprising had there been maybe more dissents. I think everyone expected Miram to. Maybe the one surprise was that Waller did as well. You'd like to think that that's not because he's on, President Trump's short list, and President Trump has made no bones about the fact that he wants to see interest rates lower. However, I think that he's voting his conscience, as was said by some other commentators. I would expect that this is going to be language that's going to continue for the next couple meetings, assuming that we don't see more tariffs or geopolitical tensions, assuming that we see the trends in both the labor market and inflation continuing to normalize. If the market had gotten a 25 basis point cut, I think that would have been somewhat good news, bad news. We probably would have seen stocks rally, but at the same time, I think long-term bonds would have taken that as a sign that maybe that the Fed has lost the plot a little bit, or maybe losing some credibility. And there's something that Jerome Powell was very strong about that he does not, and it's very important for financial markets. So I think this is just what the market needed. You see, very muted reaction both from stocks and bonds, which means this is pretty much what's priced in.
Yeah, I mean, the S&P 500 just really teetering around the unchanged line for most of that press conference, which perhaps goes to show that maybe they're waiting for some direction, maybe they're just still trying to digest all of this. I wonder if it's got anything to do with the fact that Powell seemed pretty bullish on the economy, at least that the data, he says, suggests things have started on solid footing for growth. Do you think the markets can wrap their heads around an acceleration of growth and fewer rate cuts in the system this year? Do we need them?
Calls?
I think that, he was pretty clear that, the economy doesn't need them at this point. I do believe that, we continue to grow. Now, we need to watch, the dollar. It has obviously sold off a lot this year. We have, President Trump saying that he likes the weaker dollar, but, the Treasury sector is Besant saying that, no, the U.S. still believes in a strong dollar policy. I think that that's something to worry about, as well as geopolitical tensions. But the fact that, we've kind of stepped back from Greenland, we'll have to see what happens with Iran. That could be, something that could potentially, spoil some of the enthusiasm in the market if we see, more geopolitical tensions or more, messy conflicts. But at the moment, we seem to have, stepped back from a lot of the saber rattling. If we can, just continue to move as we are and not rattle the table too much, I don't see any reason why the market cannot continue to grow the way that it has. And I think that the equity markets, will continue to rise. It's very difficult to fade them at this point, despite the fact that the Magnificent Seven is trading at very high multiples. Just because the Fed was kind of accommodative. It was just what people expected. Powell did not rule out cuts later in this year. Now, they may not come as soon as some people had hoped last year, but there's still expectation there's been 2 rate cuts, potentially starting in June. I think that that'll help the market as well. I think it would have been much less bullish had Jerome talked more about his inflation fears.
And Christian, as we look at positioning in this environment, this potential, we don't know when it's coming. We're still very much in wait and see mode. Does today's decision to leave things unchanged and stay in this holding pattern scenario just continue to reinforce the idea of how much diversification matters right now, more than actually trying to time out when that first cut is going to come?
Oh, 100%. I mean, it's very difficult to time the Fed, especially because a lot of that's going to be priced into the market well ahead of when they actually make the rate decision. It's very rare, especially for the Federal Reserve, to do anything in a surprise manner. They're very good about telegraphing to the market, unless in times of extreme stress. And so diversification is key for any portfolio, especially when you do have concentration risk in the equity markets. I mean, that is great and has led to fantastic performance, but it also leads to potential volatility risks. When the indices are dominated by a few big names, if one of them were to wobble, you could see performance in the entire index come down pretty precipitously. So we're huge fans of diversification. As people say, it's the only free lunch in investing, and we like to use alternatives as a way to diversify away from the public markets in order to get some tax efficiency, as well as enhanced income, as well as opportunities that aren't necessarily available in the public markets.
Christian, we've got to go, but we really appreciate the reaction today. Christian Solomon there, Ballas Rock of Private Wealth, joining us. Thanks so much for your time. Coming up next, we will be joined by the CEO of Virtuix. We'll learn more about this company that combines virtual reality with omnidirectional treadmills. Coming up next on Market on Close.
don't stop when the market day ends. So neither do we. Schwab